Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for checking out the Market Chameleon pre-market show with this man, all the way from, I thought it would be sunny in the background, but it's not, Dimitri Pargamonik in Philly.
Hey, Will, how are you? Yeah, in Philly, but I am going down the shore later today.
Yeah, they just reminded me on the chat, Mike, that Monday is Labor Day. So let me know pre-market show this coming Monday because everyone will be off, hopefully enjoying the fruits of their labor via Labor Day.
Yep.
Right?
Yep. No, so no show Monday. Markets are closed. We'll be back on Tuesday.
Yeah. You want to start with the disclaimer? It's up there for everyone to take a gander at.
Yeah. So good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Perfect.
And with that, let me share my screen. And today, actually, let me get to the pre-market report. I'm going to try to cover some of the residual questions we had from this week. One, I think, was regarding implied volatility, the IV30, and the implied volatility percentile rank. So what is the difference between the two? I think another question had to do with how we're calculating theoretical values and the data set we use to estimate those values. So the historical data set, why do we use sliding intervals instead of rolling days? So I'm going to try to cover those two questions today. Am I missing any other ones?
Nope, those are it.
Okay. So I'm going to try to cover those today. We'll start out with the pre-market report, and then I'll move on. And I did get some comments, like actually 2 emails yesterday. So I'm going to try to address them because they were very similar. So I got 2 different emails yesterday, and as I was reading them, they contain something that is kind of very similar and that I kind of hear often repeated. So I'm going to try to also address those. So I'm going to let's start with the pre-market report, and then I'll get to the emails. Then we'll get to those 2 questions. Sound good, Will?
Perfect.
All right. So this is the pre-market report, and these are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, I see 131 stocks made our percentage gainers list, 40 on a percentage decliners. So right now, from that perspective, looks like we're setting up for more bullish bias at the open. I'm going to filter down this list to just S&P 500 stocks. So we could see what's going on if we take out all the small cap stocks, ETFs, leverage products, preferreds, closed-end funds. Let's take all those out of here just to see what's going on in the S&P 500. So to do that, I'm going to use this filter here in ETF. Let's drop it down. And by selecting one of these ETFs, that report below will get filtered by the holdings in that ETF. So SPY, that's the S&P 500 ETF. Select that. Now we see we got 13 stocks that made our percentage gainers list, none on the decliners. So right now, from this perspective, we're looking like we're setting up for more bullish bias at the open. So let me, before I move on, Will, I don't want to read the emails because some of them are lengthy, and one of them, it starts out like, I enjoy your show, thank you for the stuff that you're doing. Tried a couple trade spreads. So I'm assuming like they saw maybe the bull call spreads. So he said, in example 4 to XY SPY. Okay, so I think maybe some of these in the blog, we're trying to put examples of how our bull call spread works. So maybe these were the places that he was looking at. And so, and this is what, and by the way, thank you for the email. It was mostly, it was a nice email, right? So I do want to thank you, but I wanted to bring out about something. So, I try to trade the spreads. He said you proposed by email and got wiped out in this bear market. So he listed like 3 spreads. And then I got another email, something similar, and he didn't say, but it was, I'm going to paraphrase it. In my opinion, the overall performance is the most important factor to me so that the trader can keep earning rather than being blown up by several bad trades. And this is a common thing, I think, that I kind of hear repeated, that, I've been blown up by several bad trades. And when that happens to you, you broke the cardinal rule of trading. What you didn't realize is that you already set yourself up for failure. Mathematically, you can't win. So if you're in a position that you did 2 or 3 trades and you blew out your account, that there's in no universe that in the long term you could be successful. What's the cardinal rule of trading? Well, I mean, you could Google this, Well,
it's like, no trade or no position should be more than 1 to 1.5, maybe 2% of your position.
2% would be like aggressive, right? Like if you lost 2% on a position, like completely your position just went to 0, that's aggressive already. So there's no way, even no matter what you do, that's not trading, because then it's like trying to show up to a poker game and going all in on the first 2 rounds, and if you win, you keep doing that, going all in. Eventually, you're just the pot's gone, right? There's no.
Yeah, and the other thing is
possible to.
All his positions were bullish in a market sell-off, right? I mean, when he stuck his toes in the water, market selling off, you're not going to find too many positions that are, going to benefit in it. At least you knew what your downside was. I'm sure in all those trades.
Right. That's why we pick up call spreads. It says in the call spread.
Hey, D, your mic, you have to jiggle your mic. It went underwater.
Let me see. How's that? You're on mute, Will.
Yeah, you may have to come a little closer. Try more, move the mic closer.
Hello?
Yeah, it's still got a gravelly voice.
How's that?
That's good.
That's good. All right, I just took it out. So when you're talking about something like that, you basically created a situation that would be impossible to be successful in the long term. And the reason you do a call spread, like why is this call spread being filtered out? Because the whole idea is that you could be very, very small. Here's a call spread PBR, 85 cents. One call spread, the risk is $85, right? So that's it. You shouldn't, it goes to 0, it's $85. Now, if that wipes you out, you shouldn't be doing it. I mean, your broker shouldn't even really be allowing you to do that. I mean, that could be another problem. But there's no way, imagine a bank, or any trading operation out there to, have 50% of their portfolio in one trade or holding one risk asset, or anything. It would not make any sense, So I was playing while we were down the shore. I got invited to a poker game, and we changed $20 in chips for fun, and we're sitting around. And I think, and I know this because I think there was like 6 of us, so we took turns dealing. it took maybe like 12 rounds. We went around twice before, somebody had to actually cash in more chips, but, and these were nibbles. So, imagine if in two or three, this is going to be a problem, because I don't know, anybody in what universe or in, how good you are that you can be successful in the long term, because you're just breaking the cardinal rule of risk. A couple other things that these emails, and I'm not picking on you guys, I am trying to really make the point, that you just can't be doing that. You shouldn't be doing that. It doesn't make any sense. A couple other things that it had in common was, one of the emails was, well, I need the exact, I guess, I'm trying to paraphrase it but I need the exact price I should get in, exact price I should get out, when and how. And, trading, first of all, that's not a trader, right? You're not a trader does research, makes those decisions. That's what you're asking for, is like being passive, right? So if you're passive, if you're just looking for somebody to do it for you, what you're really looking for is like maybe a hedge fund or a mutual fund, or you could do passive investing through an ETF, or you could just invest in a company, right, that's engages in trading. So what a trader cannot be passive, right? When you're self-directed and you're making decisions, there's no way you can be passive, right? You have to be in there making and learning and doing those decisions on your own. Otherwise, you can't. I think like some people look at it as a side hustle, right? This is something I'll do on the side for extra. You can't do it that way, right? You're talking about trading. You're competing with some of the world's smartest, brightest, most educated, and most informed people out there, right? So it's not a side hustle. You can't treat it that way, and you can't dabble, right? You shouldn't be doing that, or just invest in something that's more passive and have professionals manage your money. So the other thing is that, and this comes up, why this comes up is that some people believe as a trader, what your job is to, and while I'm doing this, can I ask a question for people just to put in to hear their answer? As a trader, right? As a trader, you might have your top 10 list of the most important things you need to succeed as a trader. Just out of curiosity, like, what would people's number one be? If you had to make a top 10 list, your number one, what's the most important thing you think you need to be successful as a trader? And read them back to me, afterwards. I'm just curious to see what people say. But another thing that this had in common, these emails, were that the assumption was that you had to, as a trader, be right in predicting where the stock market will be tomorrow or a week from now, and so forth. And, like, tell me exactly where the prices will be tomorrow, or is the market going to be up or down tomorrow, or is Apple computer, what prices is the Apple computer going to be in 2 weeks? And that's impossible to do, right? Nobody knows that. The New York Stock Exchange doesn't know. The NASDAQ Stock Exchange doesn't know. The U.S. government, right, with all their resources, do not know where the stock market will be tomorrow, or or what the what Apple computer stock will be tomorrow. And so then what is the point, right? So the point is, I don't know, right? If you gave me a coin with the heads or tails, I cannot tell you if you flip it, if heads or tails will come out. I don't know, right? There's no way of me knowing. But what I can tell you is that there are only two outcomes, heads or tails. So you have a 50-50 chance of landing on heads or tails. And what else I could tell you is, if somebody told me, hey, Dimitri, if I flip this coin and it lands on heads, you pay me 90 cents. And if it lands on tails, I'll give you $1.10. Well, now I could tell you that I have a 10 cents edge on betting on tails, right? I don't know if heads or tails will go up. That's not the point. I have no idea. I just know there are only two outcomes, so it's 50-50. And I know that I'm risking losing 90 cents to make $1.10, and there's even odds of both. So those are the things as a trader we start to look at. Now, of course, if I have a coin, or even if I have a roulette table, I could easily calculate the odds and probabilities because I know I know all the possible outcomes, right? Either heads or tails, or roulette table, 1, 2, 3, 4, 5, up to 36, green or red. But trading isn't, when we're talking about options and stocks, the outcomes are not, they're not laid out that way. It's not that easy, right? Because there's lots of different outcomes and possibilities and factors that go into play. So that's where it gets much more trickier, where now you have to use data and information to start creating estimates, right? Like an insurance company, they start creating estimates, right? They don't know all the possibilities, right? That you go driving out in a car, they don't know what you're doing, where you're driving to, all these. So they start creating estimates on those insurance policies. And that's kind of what, trading is. So we don't know. There's no way of knowing if tomorrow the stock market will be up or down, but we can start consuming and analyzing to see what do we think, what is more likely, and what are the payoffs, and are the risks worth the reward. And so, Will, did you get any answers yet?
Oh, we got some answers.
So yeah,
one being small, consistency. Mike's still checking. He's got a list in the back office. Brenda, education. First place, Jim, risk management. Verified King, knowledge, patience. Chuck is maintain my capital, which I would put under risk management. John, risk management. There you go.
So I would say a lot of those are good ones. They're on the top 10. But imagine what if you were going to play poker, right? Like a poker game of chance. And maybe they're top two, maybe they go together. I mean, first you have to know the rules, right? So if you don't know the rules, then you're not going to be able to, what are the rules in poker? Well, this beats that, but for a trader, what becomes the most important part, of course, assuming you got the education and you know the rules, because without that, it'll be hard to play. But it's information. This is what trading is. It's information. It's not guessing. You're not, if you don't have good information to act on, if you don't have that and somebody else is more informed, it won't matter really even how you manage your risk, because what is your edge, right? It's because all you're doing is just moving money around. So information is actually the most important thing, and that's what people will pay for the most, right? I'm talking about as a retail investor. Obviously, you're not, if you're a broker dealer, there might be some other things that are more important, or just as important, but it becomes information is the most important thing when because remember, you're not engaged in producing a product or service, right? That's not what you're engaged in. It's not like you're creating this product and trying to sell it higher, and you're not creating a service for anybody. What you're trying to do is assess information and the person, and that's what your edge is. That's the most important part of the puzzle, putting the pieces together.
Well, I did a quick search on the internet, and in Investopedia top, when I typed in your question, popped up there 5 keys, and research was number 2.
So research, and right,
and analytical skill. Well, I don't know if it's in any order. They said analytical skill, research, focus, control, and record keeping.
Right, being organized, being right, but that's all key. That the most successful people, and I talk to a lot of you guys, you know, even on the phone or by email, and I know many of you do a lot of reading. You know, consume a lot of information, you know, subscribe to a lot of different services and Wall Street Journal and Bloomberg. And so, you know, some of the emails I get is like, you know, people dabble in it and expect to, like, you know, make 2 trades and build their wealth off that, you know, hit it big after 2 trades or 3 trades, or treat it as like this side business or side hustle, and it just doesn't work that way. You know, there's nobody that can do that. Those expectations are just too unrealistic, you know. So and it's, look, I don't want you guys to, you know, you wouldn't, Market Chameleon wouldn't even be able to help you if that's the mentality, right? So you shouldn't even be subscribing to Market Chameleon, because there's nothing that could help you if that's, you know, if that's your viewpoint, that, you know, I should, in 2 or 3 trades, you know, I should be like,
well, Robin Hood tried that, right? Their whole model where people, you know, follow other people and just, you know, they could execute trades off other people. I mean, they had small accounts, and it was a real big problem.
Yeah, it could be a really big problem. So let me move forward though to SPY. I'm going to use that as the, you know, example, implied volatility and IV percentile rank. So the first thing is, what is the 30-day IV, 30-day implied volatility? And when we look at options, right, implied volatility is not, it's a derived value, right? It's not like a stock price where here's a stock, it trades at a price. Like this 399.43, that's actually, somebody bought it and somebody had to buy it, somebody had to sell it. It was a transaction, and that's an actual price. It's an observed price. Implied volatility is not like that. Implied volatility is a derived value, okay? Which means it didn't trade anywhere. You can't really, it's not like something you're buying and selling. It's a reference price, and it's derived from option prices, bids and quotes, right? And when we look at option prices, well, we got a large amount of, you know, strikes. Like here in SPY, we got all these different strikes, you know, all these different bids and offers. We have calls on one side, puts on the other, and we have all these different expirations. And each one of them, if you plug in, you know, the price of this option, you know, with this strike, with this many days to go, with, you know, your interest rate assumption, dividend assumption, all this, you're going to get an implied volatility. And this implied volatility is specific to exactly this price in this call option, right? And if I take a different option with a different strike price, different price, I'm probably most likely going to get a different implied volatility. So at any given point, right, when you have an options chain this big, you're going to have as many implied vols as you do option contracts, bids and offers, and so forth. So when we're talking about SPY, I don't know, it could be in the thousands. So what implied volatility do I pick? Like, how do I assign an implied volatility to SPY when there are different implied vols on different options everywhere? And the way that the industry did it is say, let's standardize it to one contract, right? So let's assume there's only one contract that we reference, and we'll see if the implied volatility for that one contract goes up or down. But how do you pick that one contract? Because this contract here, is going to eventually expire. And every day the variables are changing, because as it gets closer to expiration, the days to expiration changes. And as the stock price moves, right? If the stock price moves, then this option then becomes either more in the money or more out of the money. So even following just one contract is not possible, right? Because tomorrow we'll have less days to expiration and the stock price will be further away. So since there's no one option contract to just follow, what you do is you create a synthetic option that has a constant maturity and a constant distance from the spot price, right? So we call it at the money. And that's what the 30-day IV is. What it does is it first says, how do we create a constant maturity? And we pick 30 days. So 30 days is really the standard. That's what the VIX is, 30-day constant maturity, like a 1 month option. And how do we do that? How do we create a 30-day constant maturity? Because, I could get strikes close to it. I could get like maybe, hold on, where am I here? Probably here. These are 35 days away. I could get like, here's 30 days, but tomorrow this will be 29 days away. That one will be 34 days. So I can't find one every day that's going to be exactly 30. So I have to then interpolate a 30-day. In other words, I have to go in here and say, okay, find me two expirations that straddle 30 days, right? And then take a weighted average between the two and keep that formula consistent. Okay, so that's what's happening. You're taking two expirations straddle 30 days. You're looking at the implied volatilities and taking a weighted average between them to basically estimate this is what's most likely would be the 30-day option, based on the implied volatilities between the two. Now, same thing with the strikes, right? So this stock is going to move around. So what you're trying to see is, okay, I'm trying to track what an at the money implied volatility is. So basically the strikes that would be closest, but of course the stock is moving around. So you would have to reference strikes that surround the spot price. Really it's the forward price, but let's just, to make it easier, let's call it spot price, and take the weighted average of that, and then keep that formula consistent. So then you could continuously track 30-day IV and how it's changing, right? So that's the 30-day IV. It's a 30-day constant maturity option. You have to create it synthetically to get that implied vol, because it doesn't exist. So once you have that, okay, great. Now I have this reference point. Today it's 22.6, right? So that's the 30-day IV, 22.6. So how do I know if that's high or low? And there are different ways to measure it. You can do it against historical vol or whatever, but one way is implied volatility rank. And implied volatility rank says, okay, here's the 30-day IV. Show me, like, this is today's, and this is what it's saying is, show me the end of day value for every day going back a year, 252 trading days, right? So now let's say I have them all in front of me, right? So I have 252 observations, and some of them are going to be higher, some of them are going to be lower. And the IV rank tries to say, what percent of the days was the implied volatility lower than current vol? And that's what this is, 66%. 66% of these synthetic implied volatilities, 66% of the days, the implied volatility in the last 252 days were lower, which means 34% were higher. And this kind of gives you a sense of where the implied volatility is along, that measuring stick. All right, so that's the IV percent rank.
All right. That's
I'm
perfect.
right up at
We just went through the opening bell. Awesome job on that, D. Some great lessons today for the Chameleon community. Thanks for answering. I think that was Michael McCrae who asked that IV question. Yep. Awesome job. I guess we'll get to the other question on Tuesday because Monday is Labor Day. So everyone have a great Labor Day weekend and we'll see you on Tuesday. Thanks, D.
Great. Thanks everyone for joining. Stay safe out there. Have a great trading day. Have a great weekend and hope to see you guys on Tuesday.
Thanks, D. Have a great weekend yourself.